What's up, guys? It's Chris Conlon, your home lending guru here in California. And today we are going to break down a very, very special one to me. Now, this is a cash out refinance versus a HELoC and what those actually mean. And the question to you is, are you strapped for cash? We've got a lot of things going on. We've got heavy inflation, meaning that things are more expensive now today than they were just a couple years ago. We've got just a lot of consumer debt that has hit the marketplace, and credit card bills are at an all-time high. We just hit $1 trillion worth of credit card debt, which is the most we have ever seen as a nation. So if you own a home, you may be in luck. There may be some ways to get you out of this debt. And on this video today, we are going to break that down. So stay tuned. We're going to get into it right now. So the first one we're going to get into is a cash out refinance. So here's how this works. Let's say that you have a loan for $400,000 and you needed an extra $100,000 in cash to pay off the debt that you've accumulated. So what we would do is we would make that next loan for $500,000 and we'd pay off the $400K. And this will leave a difference of $100,000 that you as the client can do whatever you want with. You can pay off debts, you could pay off your cars, you could pay off whatever you need to do through that cash out refinance. That's how it's going to work. It's very straightforward, very simple. That's how we do it. It's really that simple. It's one loan, one lump sum, one payment. You can do what you want with the money that you get back. You can pay off debt. You can use it towards something else. Again, it really is that simple. And sometimes you can even lower your interest rate. In today's market, interest rates are higher than they have been in the last decade. Now think about this. People that refinanced in 2020, 2021, and even 2022 had a much lower interest rate than what today's interest rates are. Think of somewhere in the 2.75% to the 3% interest rate. Now today's going interest rates are anywhere between 6 and 7.5%. So why would you want to refinance out of those lower interest rates to get into something higher? Now I'm going to help you understand this. We're going to break this down. Think of your interest rate at 3% on your first mortgage at $400,000. But let's say you have car loans, let's say you have credit card bills, let's say you have student loan debt that is now pushing 20 to 25%. If you look at the balances and you combine the two, your blended interest rate is actually much higher than that 3% that you have on your first. So if we combine everything together and get things paid off, you're thinking of yourself as a business. You're creating cash flow. This can be very, very helpful to some clients and get them out of that nagging debt. I'm going to give you a real life example of one of my clients right this very second. We're going to break down their debt line by line. Right now, they have a home loan and their balance is $400,000. Their current interest rate is at 3.5%. They have credit card debt at $40,000 and their average interest rate is 29%. Next is they have their student loan debt, which is at $75,000 balance, and their interest rate is at 9%. They do have a car loan of $50,000 balance and their interest rate is 7%. They also did take out a personal loan for $25,000 and the interest rate is 15%. Now, if I combine all of those together, the blended interest rate is at 6.712%. In this scenario, this client has over $190,000 worth of debt at a very high interest rate. So what we would do is we would increase their loan from $400,000 to $590,000. We would take one lump sum, pay off all of their debts, and now what happens is all of the monthly payments are now wiped out. This is going to save them thousands of dollars from a cash flow perspective in their monthly budget. This scenario works because our client does have a great equity position. Now they have a lot of debt on the back end, but they have a room in their equity position. Their house is worth over $800,000, so we are safe when it comes to pulling the equity out to pay off all of this debt. Now, let's say you're in a different category where you do have debt, but maybe it's not nearly $190,000. Maybe it's closer to $25,000, $50,000, maybe even $75,000. And you've got that lower interest rate on the first that we certainly want to protect. You are not out of luck. Now, on this next one, I'm going to show you how we can use a different product to pay off that debt, increase your cash flow, and protect that interest rate on the first. Hang tight. Another option that we have to tap into the equity from your home to pay off some debt or get some cash is called a HELoC. That's a home equity line of credit. And it's exactly what it sounds like. It's a line of credit based upon the equity of your home. Let's say you get approved for a $100,000 equity line and you only use $30,000 of that. you're only paying interest on that $30,000. You may or may not have heard of this before, but don't you worry, I am going to break this down. I'm going to give you some more options. I'm going to show you exactly the way it works. So what's cool about these equity lines is they are super flexible. Now they do have a draw period that lasts from 3 years to generally 10 years. And what that means is you have access to those funds. You can write checks, you can use a debit card, you can access this money at any time to use it however the way you want. Paying off debt, going on a vacation, financing a wedding, whatever you want to do, you have access to those funds. Now, what is even more cool is that you are only paying interest on the used portion of those funds. So if you have a $100,000 equity line and you only use $30,000, you are only paying interest on that first $30,000. After the 3 to 10 year draw period, the access to those funds is gone, meaning that you can't write checks, you can't use your debit card, you can't use the funds to that money. Now, don't worry, it doesn't become one lump sum that you have to pay back. It does go into a fully amortized payment that typically lasts between 10 to 20 years. Now, your payment does go up a little bit, but you are paying off that debt. And guess what? The best part is we did not touch that 3.5% interest rate that we have on the first. Another thing to note is typically on an equity line of credit, the interest rate is usually a bit higher than it is on the first because we do follow prime rate. Now, the other thing that you really want to pay attention to is that the rate can also be variable. It can be variable during that introductory period where you have the funds to draw from, or it can be variable for the life of the loan. You just really want to check your terms. Now, if you don't like variable interests and that really freaks you out, don't worry, I have another option for you and we are going to break that down now. Introducing the HELoan. That's exactly what it sounds like. It is a loan in second position where we are working with the first, keeping that intact and having a second loan on the back. Now remember, this is one lump sum. There is no draw period. And typically the terms are 15 years, 20 years, and 30 years. So remember, there is no access to that money. It's one lump sum and you can do whatever you want. Some of the examples that we have are you can even buy a new home with this and use it as your down payment. You can pay off credit card debt. You could go on vacation. You can use these funds however the way you'd like. Now, the reason why a consumer or client would use this over the second option with the HELoC is because it is a fixed rate product, meaning that it never changes. If you are adverse to risk, this may be the product for you. Let's recap. I've given you 3 different options to access the money inside your home. Number 1 is going to be the cash out refinance. Now, this is one lump sum. Again, you get a big fat check at the end of your refinance. We pay off the first and you start on a brand new loan. The next option would be the HELoC, which is home equity line of credit. Just like it sounds, it is a variable line of credit that you can tap into and access those funds from your home to do with what you want. Now, the third option is going to be the HELoan. Now, this is a fixed rate debt, meaning that you are just taking a second loan, just like your first. Again, you get one lump sum, you can use that, but you are protecting the interest rate on the first. Isn't it cool that there's an option for most everyone? Now, maybe you're the person that was living the life, racking up the credit card debt, going out and getting bottle service every single weekend. Maybe you're a parent that has a child that's wanting to go to college and you need the funds to access to get them through school. Maybe you or a family member are having some health issues and insurance is not helping you with those costs. We've got meds that are expensive, we've got surgeries, and we've got doctor visits that may just not be covered under the insurance, and you need cash fast. Maybe you're an entrepreneur, a real go-getter, and you are trying to buy your second or third house, or maybe just trying to start a business to really make your assets grow. Now, one of these options is probably something that could work for most everybody. The world of home ownership is wild, and I hope that after watching this video, you truly understand that there are options for you by being a homeowner. Now, people get stuck every single day, but by owning a home, this provides some option and some real relief to certain people. Now, it is ultra important that you get with a professional to go through these different options because they can be very complicated and the knowledge needs to be vast with the professional that you work with. Now, I've been doing this for 20 plus years. I have a real passion for helping people, and this is truly my vocation. So if I can be of any help, please reach out, leave some things in the comments if this gave you any sort of clarity, and I want you to do me a huge solid. Please hit that like button, Make sure you subscribe to this channel if this has brought you any value. And if you know someone that is maybe struggling because of debt, please do me a huge favor, share this video with them and make sure that they know that help is on the way. Now, I appreciate you guys watching. Stay tuned for the next one, and we're gonna break down some great stuff next time. See ya.